how high do you see that 10-year Treasury yield going?
Well, I think we're basically in the ballpark here of what fair value is on the 10-year Treasury. We've gotten to a point where the rise in interest rates is significant enough to start to create that drag on the economy, and that drag on stock prices, right? And you could see that in the intermarket action, which is that you're starting to see stocks fall, meaningfully relative to bonds. And at a 5% yield, over a long term, you're starting to see term premiums in the bond market get up to the highest level that they've been, post financial crisis, and sort of at an average-ish level, prior to the financial crisis. And given the liquidity in the system and things like that, and the high levels of that, you wouldn't necessarily expect to have a circumstance where you get to term premiums that are as extreme as they were, say, in the 90s. And so, on a value basis, what I'd like to say, look, the easy money has been made being short bonds. Like maybe they'll go a little bit higher, but the story is that they needed to move to levels that are basically in this range to start to kick off the slowing of the economy and the turning of the cycle, and that's where we're at.
So we spoke briefly about this before we went on the air, about Jamie Dimon's comments regarding a 7% 10-year Treasury yield, and he had said it, like you had brought up, for the banks to just to be prepared in the event that we do hit that. Do you think we even come close to a 7%, or is that just
it's Jamie Dimon, for crying out loud? He's no macroeconomist. Hello.
Well, I think he's a banker, though, and
he's a banker, and I think what he was saying, which is prudent, is that you should, if you're sitting in the bank risk manager position, you should be stress testing your book at a 7% yield, because that is a totally plausible. It's a plausible outcome. I'm not saying that it's the likely outcome or where I think we're going, but from a risk managers are paid to think about a wide range of plausible outcomes and making sure the bank doesn't blow up along the way. And so, you got to be thinking about what 7% could mean. And so that's really, I think, the way I take his advice. I think the odds that we get into that range are not that high. And the reason why that is that would imply a pretty extreme term premium on the long end, hundreds of basis points of premium, which, would be, would almost certainly start to create dip buyers into this into the bond market, right? Yield buyers into the bond market. The other thing I'd emphasize is, if you get that, that's a 250 basis point move up in the bond yield. Think about what the direct impact that will be on stocks, right? You're talking about a 25, 30%, even maybe more drag on stocks. And the point is that sows the seeds of the reasons why it would not happen, which is you start to get the stock sell-off that we're seeing, which starts to get people to look at the bond market as an attractive asset relative to the stocks, which creates the bid out of, the move out of stocks and into bonds, and essentially puts the lid on the stock price at this term premium. And so that's what you have to think about, is that they intersect each other. Like, asset prices in general might be too high, but it's really stock prices are way too high, and bonds are kind of in the ballpark at this point.